welcome back. So, on this episode, we're going to talk about some different types of aristocrats and some different types of dogs of the Dow. Now, these are both dividend types, dividends that are very popular with a lot of other people and different categories. So, let's jump into this. So, first, we're going to talk about dividend aristocrats. This is from Investopedia's website. Basically says Dividend Aristocrat is a company. A dividend aristocrat, if it increases its dividend, pays to shareholders for at least 25 years straight. So increase meaning the amount of dividends that they pay, not the share price. So they've increased their dividends payouts for 25 years straight. Um, Says they tend to be large, established companies with no longer enjoy supercharged growth. Most are largely recession proof, enjoy steady profits in good times and bad. So basically, they have really good balance sheets and are companies that have been around for a long time and have been through a lot of recessions. So the 2008 recession that people may be familiar with, and the current one that we're facing right now, financial crisis wise, wouldn't call it a recession yet, but the financial crisis we're currently in, they've basically survived through those or are currently surviving through those because they have good balance sheets and they've increased their dividends for 25 years straight. So let's jump into some of the ones that are on there and let's see how uh, what you can actually um, what they actually pay out. Before we do that, let's go to some of the dividend aristocrats on here. They have AT&T as one, ExxonMobil, Walgreens, and AbbVie is one of them, or three of them, four of them. So let's go to the top because I have three of them picked out, and let's just see how much they pay out. So if you were to get them currently today. So if you owned one share of ADM, which is Archer McDaniels, company that produces, they're in the food category, but if you were to have them today, you will be getting a 36-cent dividend per share. So for whatever share you have, you get 36 cents going to your account, whether that's M1, Robinhood, or Webull, every quarter. And it says right here quarterly, so those are stocks that pay every 3 months. That's a quarter. So that's no, yeah, every 3 months. So that's a quarter, and it'll tell you the date right here. So on the 5th, they're going to pay 36 cents. But what I like about their website and what most websites have is they'll show you the history. So if you got back in 2012, you got 17 cents, and then you still held it to 2013, then you got 19 cents. You held it to 2014, you got 24 cents. Held it 2015, you got 28 cents. 2016, you got 30 cents. 2017, you got 32 cents. So the amount of money that you essentially have gotten has increased. So your paycheck has increased from you just holding it. So you're essentially getting a raise every year from just holding the stock, which is a fantastic thing if you have a large position of them in your portfolio, as well as if you have just one in your portfolio, you still have gotten an increase on your account. Going to another one, we have Tigerson CLX for Clorox. Now, if we look at Clorox, they pay $1.11, um, and they've increased their dividend as well. If we look on here, back in 2017, they paid 80 cents, 80 cents, 84 cents, 84 cents for their four quarters. Then they increased it in 2018 to 96 cents. They increased it again in 2019 to $1.06. They increased it again in 2020 to $1.11. So they've increased it, every year. This chart also shows the fact that they've increased every year. Even if you look on here, the 2008 financial crisis, they still increased their dividend. So, you know, going to here as well, they've increased their dividend even despite of what's going on, worldwide. So a good stock to hold for the long term. Going to the last dividend aristocrat on here, we have um, 3M. So for 3M, we can see if you had one share of 3M, you'll get $1.47 per share. And this is their 2020 distribution. If we go to their 2019 distribution and declaration, we can basically see you got paid $1.44 per share. Now, when looking at dividends, they have the declaration date, ex-dividend date, a record date, and payable date. Payable date is basically the day you get paid. Amount per share is how much you'll get per share you own. Record date is basically the date that they record that you have the share in your account. So it's a very important date, basically the date you need to have the stock in your account by in order to get this $1.44 per share. And this is standard for all dividend stocks. So it's the same for Clorox, ADM, and any dividend stock you're looking at in the future. If you hear somebody say the record date or the payable date or the declared date is basically the day they say, hey, we're going to pay this dividend. So it's basically what that means. Payable is the day you'll get paid out that dividend. So those are pretty common terms as far as dividends are concerned, and just some to look forward to when jumping into the world of dividends. Now we're going to go to dogs of the Dow, which is another form of dividends, which is another well-known strategy that people may not be familiar with. The dogs of the Dow is well-known strategy first published in 1991. Strategy attempts to maximize the yield of investments by buying the highest paying dividend stocks available in the DJIA. So that's the Dow Jones Industrial Index or Industrial Average. The strategy's track record shows it beat the index during the 10-year stretch that followed the financial crisis. So basically, the methodology is basically to get the highest paying dividends from the Dow Jones. And here's a small list of it right here for 2019. I will drop a link to this down below so you don't have to screenshot this. But we basically have IBM, ExxonMobil, Verizon, Chevron Corporation, Pfizer, Coca-Cola, JP Morgan, Procter & Gamble, Cisco, and Merck Corporation. Now, Merck just had a earnings last week and it was pretty good. So, these companies are pretty solid companies as far as, earnings are concerned, and they're very profitable, and they still give off dividends. So the companies that give these dividends are not bad companies. So you could trade them for growth stock as well as trading them for just holding them to get the dividends. So it's kind of a win-win in both situations, in my opinion. But we're talking about dividends, so let's go into one of them. So Verizon is one of the ones that was on that list. So if we can see on their dividend, they pay 61 cents per share. So if you get it today, you'll get 61 cents per share in 2020. And then if you had it in 2019, it was 61 cents per share. They increased it at the end of 2019 because it was 60 cents a share, and then it went to 61 cents. So you're actually getting more money now per share than you got last year, which is always a good thing, and an incentive to hold the stock. So going into another one, we got ticker sign P&G for Procter & Gamble. So Procter & Gamble is a company that sells Tide. They sell toothpaste and all types of detergents, and they have a whole list of products. You can go look them up, but basically household personal use products that everyone uses. So they're essentially a recession-proof stock, in my opinion. Going into some information on them. We can see their dividend. You'll get 79 cents per share. And it's quarterly as well, so they show the frequency on here quarterly. Like the other one that I said, they have the ex-dividend date, record date, announcement date, and pay date. So this is the date you'll get paid, and this is how much you'll get paid. We also see on here they've increased their dividend as well. So a lot of these companies increase their dividend, and they have a dividend yield. So their dividend yield here is 2.70%. Which to me is pretty good. It's a little bit on the low side, but I think it's still pretty good. A lot of the more stable companies will have a lower dividend yield compared to other companies, but they still will pay a steady dividend. So the amount you'll get 79 cents. If you had it previously, you have 74 cents and 71 and 68 cents. So let's jump to the last one. on the dogs of the Dow, and that's going to be Pfizer. So Pfizer, is a company, to me, is recession proof as well. Definitely along the lines of the whole pandemic situation. They've been in the news for, being one of the companies that has been on this whole, fast track or warp speed plan for the U.S. government. So, a very relevant company, not only just for dividends, but for growth stocks as well. So on here, you see the dividend date, the payable date, the record date, the X date, type regular cash. And if you look on here, it's going to be quarterly as well. So we looked, the amount's 38 cents. You would have got paid 36 cents in the past, 34 cents. So, they're increasing their dividend as well. And that's just another way to grow your account. So if you own these stocks, you'll get these dividends. They'll go directly to your account. If you have M1, they'll go directly in there whenever they pay out. You don't have to keep track of it. M1 keeps track of it for you. And it's just another way to grow your account. So, you have all these different dividends coming to your account, and you can reinvest those dividends to grow your account, to make it, more money. Or you can use that money and subsidize it for, you know, buying groceries or paying bills or whatever, because it's your money. They basically pay you to own these stocks, and that's why I think dividends are so important, and why I think everybody should trade dividends. I'm not a certified professional advisor, so I'm not one. So if you need one, just go check your local listing and find one. This is just all to point you in the right direction and just show you that you can grow your account with dividends. And on the next episode, I'm going to talk more about dividends and how to begin growing your account and how to start your account as well. So tune in for that one, and I'll see you guys next time. Peace.